Understanding revolving credit, an in-depth overview. Revolving credit is a financial tool that provides flexibility to consumers and businesses alike. It allows borrowers access to a certain credit limit that they can draw upon, pay off, and reuse as needed. This article will delve deeper into the mechanisms behind revolving credit, its types, advantages and disadvantages, and its impact on credit scores. What is revolving credit? Revolving credit is essentially a line of credit that remains active and available even as payments are made toward the outstanding balance. Borrowers are able to access funds up to a predefined limit and can make partial payments over time. Unlike installment loans, which require fixed payments over a set period, revolving credit allows for more fluidity in repayment. Key features of revolving credit. 1. Credit limit, the maximum amount a borrower can utilize. This limit is determined by the lending institution based on various factors, including creditworthiness, income, and financial stability. 2. Repayment flexibility. Borrowers have the option to pay off their balances in full or make smaller monthly payments based on their financial situation. 3. Interest. Interest is charged on any outstanding balance and is typically higher than that of installment loans. The interest rates can be fixed or variable, depending on the type of credit. 4. Reusability. As payments are made, the credit becomes available for use again. This continuous access to funds is a crucial aspect of revolving credit. How does revolving credit work? When approved for revolving credit, an account holder can borrow against their credit limit whenever needed. The lending bank assesses factors such as credit scores, current income, and employment stability to set the credit limit. Payments made reduce the balance, and the available credit increases correspondingly. For example, if a borrower has a credit limit of $5,000 and carries a balance of $2,000, they will have $3,000 available to spend again. Late payments or defaults can negatively impact the account holder's credit score and limit their ability to access credit in the future. Types of revolving credit. 1. Credit cards. Credit cards are the most widely recognized form of revolving credit. They allow users to make purchases anywhere the card brand is accepted. Credit cards often come with rewards such as cash back, travel points, or other benefits, which can incentivize responsible usage. 2. Home equity lines of credit, HELOCs. HELOCs utilize the equity built in a home as collateral. They typically offer lower interest rates than unsecured credit cards but carry the risk of foreclosure if payments are missed, as the home serves as collateral for the loan. 3. Personal and business lines of credit. Lines of credit can be offered to individuals or businesses. They allow access to funds as needed for various purposes, ranging from emergencies to business operations. These accounts differ from credit cards in that they often require direct transfers to a bank account rather than transactions using a physical card. Advantages and disadvantages of revolving credit. Advantages. Flexibility. Borrowers can access funds when necessary and manage their payments based on their cash flow. Building credit. Responsible usage of revolving credit can positively impact credit scores, as it indicates good financial habits. Rewards and benefits. Many credit cards offer rewards, allowing users to earn perks for their purchases. Disadvantages. High interest rates. Interest on revolving credit tends to be higher than other loan types, such as mortgages or personal loans. Potential for debt. Easy access to funds may lead to overspending and increased debt if not managed properly. Impact on credit score. Utilizing a high percentage of available credit can negatively impact credit scores. The relationship between revolving credit and credit scores. Maintaining a good credit score is crucial for future borrowing and financial health. Revolving credit plays a significant role in determining your credit score, as it accounts for about 30% of the score calculation. Here are some tips on managing revolving credit to boost your score. Keep utilization low. Aim to use less than 30% of your available credit. A lower utilization ratio tends to favor your credit score. Make payments on time. Consistently making timely payments helps maintain a good payment history, another important factor in credit scoring. Pay more than the minimum. Paying down larger portions of your balance can reduce interest charges and improve your utilization ratio. Frequently asked questions. Is it good to have revolving credit? Revolving credit can be beneficial when utilized wisely. It provides flexibility and the opportunity to build credit. However, irresponsible use can lead to significant debt. What is a good amount of revolving credit? Keeping your credit utilization ratio below 30% of your total available credit is recommended to maintain a healthy credit score. How can revolving credit help my credit score? By keeping balances low, making timely payments, and utilizing credit responsibly, borrowers can build their credit scores and access better borrowing rates in the future. Conclusion. Revolving credit serves as a powerful financial tool when used responsibly. It offers flexibility and can enhance your credit profile while providing immediate access to funds when needed. Understanding the mechanics, benefits, and potential pitfalls of revolving credit is crucial for effective financial management. Ultimately, the key to leveraging revolving credit lies in responsible usage, maintaining low balances, paying on time, and keeping an eye on credit utilization. Thus, revolving credit can pave the way for financial stability and growth.